And welcome to ETF Edge, your go-to place for everything ETF related. I'm your host, Bob Pisani. Here we have three of the best names in the business with us today. Jan van Eck from Van Eck Vectors. And of course, we have Tom Lighten, a regular here from ETF Trends. Ben Carlson is also with us from Ritholtz Wealth Management. Tom, I want to start with you. I've been looking at some of the inflow numbers for the year. We potentially have a record year of inflows, although it's a little bit odd because we're talking about $252 billion in inflows. Potentially, that could be a record for the year. But if you really lift up the cover a little bit, you'll see an awful lot of this is because of bond inflows, not equity inflows. What do you think is going on here?
Yeah, absolutely. The great thing, Bob, is investors are spreading the love around all types of ETFs. Yes, as you point out, 117 billion so far in fixed income ETFs, led by a lot of the corporate bond ETFs. The Fed buying, I think, has helped fuel that along as well. But there's some other areas. There's been a bifurcation in the equity side. People have been moving away from the S&P and moving more towards NASDAQ-related ETFs, like the QQQs have 12 billion in new assets, where the S&P SPY has lost $23 billion. And a couple other things. You point out gold. Gold and commodities-related ETFs have a surprisingly $41 billion in new money coming into ETFs, with finally your favorite area, Bob, inverse and leverage, $16 billion of new money coming into that area so far.
That's hard. It's hard for me to figure out why that would be happening. Jan, you've been watching this for decades as well. Does anything strike you about the inflows this year? I want to talk to you about gold inflows in a minute, but we just put up the list. Vanguard S&P 500, okay, not a lot of surprise there. Investment-grade corporate bonds, I would not have put that on a list 6 months ago for big inflows. Triple Qs, that's the NASDAQ 100, okay, that makes some sense. High-yield corporate, you would have thought like 6 months ago people would have advised against high-yield corporate, and yet look at the money going into these. Can you make sense of all of this for us?
Bob, it's just don't fight the Fed, don't fight the Fed. Every single one of these trades, almost except the triple Qs, is don't fight the Fed. In fact, you'd probably be shocked to see that our biggest inflow ETF year-to-date is our high-yield corporate ETF, the Fallen Angel ETF, with $1.2 billion in inflows. And although the Fed literally has been buying that ETF, they only own 2% of the inflows, so can't thank the Fed for all those inflows. But it makes sense. We're going to have lower for longer and longer, and I think investors have realized that, and they're just chasing that money. And it is a little surprising given the hiccup and the large discounts we had in ETFs in the March April timeframe. So it's great to see that investors, I think, understand what might happen in different fixed income markets and still have embraced fixed income ETFs.
Yeah, and that Fallen Angel ETF has been very popular that you run. That invests in what bonds that used to be investment grade that are now less than investment grade.
It's great, exactly. They just get downgraded.
Yeah.
Quality companies that have what I call a bad hair day and get categorized as junk. And that index is, people chase performance. That strategy is beating high yield benchmarks by 5% year to date. So it's working again.
Yeah. Ben,
and Bob,
you run,
Bob, in order
you're
to,
right.
Just to add on to that, with earnings going where they are and some of these downgrades, there's a lot of attention to those fallen angels. And it doesn't mean that they're going to have a bad hair day forever. They can come back. And with this strategy, it's a real good strategy for today, because some institutions especially are forced to sell those when people like Jan can come in through their strategy and buy them in at the bottom.
Yeah. Ben, you write one of the best investment blogs on the street. I always find it informative and educational and coherent, which is, that's a compliment, believe me. And they're not always, some of the stuff I read is not always entirely coherent to me. I'm not talking about you, but other people. So highly recommend your blog to anybody who's not familiar with it. I'm wondering what you think of all of this money coming into ETFs. So you're a very broad observer of the market. It seems like low cost and passive is winning out. Is there anything that gives you pause or concerns about this ETF tsunami that we're seeing money keep coming into this sector?
No, I do think that it's on net a positive for investors. Obviously, the fact that the barriers of entry have been taken down makes it easier for people to hop in and out of things. I still keep coming back to the corporate and junk bond stuff. It's just amazing where we are compared to where we were. The LQD corporate bond ETF was down over 20% in March from the peak to trough basis, and now it's up 10% on the year. Junk was down 23%, and now it's flat on the year. Obviously, a lot of that is the Fed, but the fact that they can snap their fingers and make people feel more confident in this stuff, and people just plow in, it's pretty amazing when you think about the fact that this stuff used to be so illiquid and hard to trade for individuals.
Right. Well, Ben, this makes some sense. You mentioned don't fight. It was mentioned before, don't fight the Fed. But to a large extent, the Fed has insulated companies that have high yield, for example, higher risk, from potential losses or defaults. Somebody once described this to me as imagine you've got these aging gazelles, these older companies that have these high yield, they're higher risk out there, and they're with younger companies out there, like younger gazelles. And if you see a lion all of a sudden out there in the form of a recession, there's something that could be eaten here, meaning the older gazelles, the companies that are more at risk. But the Fed has come along and essentially put a fence around the lion. And it made it a lot difficult. It's making it a lot more difficult for companies that may have been weak already to actually default or go under. So does that make some sense to you? I mean, the market is reacting in certainly in a somewhat rational way. Or do you think the market is wrong on this call?
I think, to use your analogy, the Fed is basically a big game hunter going after distressed investors because they weren't able to get distressed prices in a lot of ways. And I think that's one of the big differences in all this, is that we didn't have huge blowouts. The spread started blowing out, but as soon as the Fed stepped in, everything came back in. So I think it really may, going forward, change the way people think about risk and how these things will work. And obviously the Fed has pushed people out on the risk curve, too, because treasury rates are so low, and just finding yield anywhere is really tough for people. So I think the way that people look at risk during a crisis could change from all of this.
Yeah, I think you're absolutely right. It's amazing how much the spreads came in once the Fed got involved.